We are going to talk all about 2 avenues for investors to participate in the real estate market without participating in the responsibilities of direct property ownership. Let's break down a topic that's very current, very relative. Let's find out what they are, let's find out the differences they are, and if it's a home run investment strategy for you. Hi, I'm Candy Valentino, and for the last 25 years, I've been building businesses and generating wealth, starting my first business when I was just 19. Since then, I've gone on to build, scale, acquire, and exit businesses, all while investing in real estate and building financial freedom. Now it's all about you and why we're bringing you the real story behind building businesses and generating wealth here at the Candy Valentino Show. Hey guys, welcome back to the Candy Valentino Show. I'm so glad that you are tuning in with me today. I hope you are enjoying our real estate series this month. So far, we have talked about all of the things, powerful tax tips and the differences between short-term and long-term holds, and the same as investing, as well as Airbnbs and commercial real estate, including the potential opportunity in the sector that is coming in hot. So if you didn't watch those other 3, go back to those episodes and check them out. I think you'll find a lot of value and education in each one. But for today, when I was deciding on what do I want to prepare for the very last episode of this series, I thought about doing wholesaling, or maybe even doing a deep dive on flipping, which maybe we will still do. You can drop a comment, either type wholesaling or type flipping below if you want to know more about either of those. But since I talk a lot about those in my content and on stage, if you've ever heard me talk, and I've interviewed some of the largest wholesalers in the country, people that are doing millions and millions, and I think even one has done over $1 billion in acquisitions, I wanted to talk about something that I don't think I've ever taught on before. Although I am very actively and intimately involved in it right now, I thought it would be great and timely in order to discuss it. So today's episode, we are going to talk all about 2 avenues for investors to participate in the real estate market without participating in the responsibilities of direct property ownership. And that is REITs and real estate funds. Now, real estate funds are gaining significant popularity, and the conversation of REITs is coming up more than ever before, so I thought let's break down a topic that's very current, very relative. Let's find out what they are, let's find out the differences they are, and if it's a home run investment strategy for you. So, are you ready? All right, if you're ready, I'm ready. Let's get to it. Let's start with the REIT. REIT is R-E-I-T. It stands for Real Estate Investment Trust. This is a corporation, trust, or an association that invests directly into income-producing real estate and is traded very much like a stock. A traditional real estate fund is a type of mutual fund that primarily focuses on investing in securities offered by public real estate companies. Now, there are private and public real estate funds for accredited and non-accredited investors that all vary in structure, and we're going to cover those as well today. But first, there are a few key differences to know about when you're looking at a REIT versus a real estate fund. A real estate investment trust is that corporation. It invests in income-producing real estate, and it is very bought and sold just like a stock on the stock market. A real estate fund is that mutual fund that invests in securities that's offered by the public real estate companies. REITs pay out regular dividends, while real estate funds typically provide value through appreciation or the terms of the fund. So let's go ahead and break down the REIT. The structure of a REIT is very similar, as I said, to a mutual fund. Investors combine capital to buy a share of real estate, and then they earn income from those shares. The SEC requires REITs to pay out a minimum of 90% of the taxable income in the form of shareholder dividends every year. And this is what makes it possible for an individual investor to earn income from real estate without you having to buy, manage, finance any properties, aka be a landlord. So there are 3 main types of REITs. There are equity REITs, which you own and operate the income-producing real estate. There's a mortgage REIT, which lends money to real estate owners and operators through mortgages and loans, or even indirectly by acquiring mortgage-backed securities. And then there are hybrid REITs, a combination of equity and mortgage REITs together. The majority of revenue associated with equity REITs comes from real estate rents, while the revenue associated with a mortgage REIT is generated from the interest that's earned on the mortgage loan. Now, REIT portfolios may include anything from apartment complexes to data centers to healthcare facilities, hotels, offices, shopping centers, self-storage, or even warehouses. And according to the National Association of Real Estate Investment Trusts, REITs own over $3.5 trillion in gross assets just in the US. So how do you buy a REIT? Well, you can invest into a publicly traded REIT, which is listed on a major stock exchange by purchasing shares through a broker or through your own online brokerage account. And you might be thinking that sounds awfully close to a stock, and that's because they are. They're traded on the very same exchanges as stocks. But REITs serve a very different purpose. They're actually much closer to an ETF, an exchange-traded fund, a basket of stocks, than an individual stock. And you'll find out why in a minute. And if you read Wealth Habits, my book, you'll see that I talked all about ETFs and the benefits for investors. Now, I know you guys love a really good condensed pro and con list, so I put this together for you. Here are some pros of a REIT. Number one, steady income. REITs are required by law, like I said, to distribute at least 90% of their taxable income to shareholders as dividends. And this can be pretty appealing for investors that are income-oriented. Number two, diversification. REITs offer a way for you to diversify your investment portfolio beyond traditional stocks and bonds, as well as providing exposure to different sectors of the real estate market. Number three, liquidity. Unlike you buying a physical real estate investment property that you own and you manage, that you might buy or sell, REITs are traded on the stock exchanges, so it gives you more liquidity and more flexibility. Number four, professional management. Instead of you having to do all of this on your own, REITs are managed by experienced professionals who handle property acquisition, management, and all the maintenance. So there's no day-to-day property calls for you for the leaky toilet or the faucet that they can't seem to shut off. Number five is tax advantages, potential deductions for depreciation, and as well as the ability to defer capital gains through the 1031 exchange. Now let's talk about the cons, because like every single investment, there's pros and cons to both. Some of the cons for a REIT is market sensitivity. They can be subject to market fluctuations, and their stock price can be influenced by interest rate hikes and economic changes in which maybe a REIT will underperform. Number two, lack of control. When you invest in a REIT, you are hands off, which might be good, but it might be bad. You have no control over the property selection or any management decisions. Number three, dividend tax. While REIT dividends are generally taxed at a lower rate, they may not be tax efficient like other types of income, such as long-term capital gains. Number four, limited growth potential. REITs focus on distributing income to the shareholders, which can be good, and it can also limit capacity for capital appreciation and ultimately growth. But a fun fact, I would bet that every single person listening or watching this right now has been in a property owned by a REIT in the past year. And you're probably thinking, how do you know where I've been? Well, have you ever shopped at a mall in the past year? Have you been in a hospital? Have you seen family in maybe an aging center or a care home? There are two huge and often well-regarded REITs. The Simon Property Group, which is one of the largest retail mall operators in the US, SPG, they have been a dominant player in the real estate sector for retail, as well as Welltower. This is a healthcare REIT that specializes in senior housing and healthcare-related properties that are capitalizing on the aging demographic. So, should you invest in a REIT in this economic climate? Well, that's for you to decide. I will share that many legendary investors are apparently loading up on them. Billionaire John Gray and Steve Schwartzman from Blackstone have acquired $30 billion worth of REITs since the beginning of 2022. But even one of America's largest landlords is still navigating these choppy economic waters. In mid-2023, the fund liquidated a lot of assets. Now, remember, all real estate funds will sell properties at some point, and this could have just been the end of their investment cycle, or maybe it was due to the continued interest rate hikes. Regardless, the wisdom here is for everyday investors, and it's this: the real estate market always bounces back. There are 4 cycles that the real estate market, and every market really, always goes back and forth between. But when we look at all the data over the last 40 years, real estate always comes back, even in the recessions, even in the market pullbacks, even when it resets. So always remember to do your research, look at the data, because like a stock, we always want to buy low and sell high, but it doesn't always work out that way. So we want to take stock, pun intended, of what a REIT is, and we also want to look at real estate funds. So let's talk about those for a minute. There are many different types of real estate funds. Now, let's talk about some of the most common. We have private real estate funds. These are private investments that raise capital from accredited investors to invest directly into physical real estate assets. Private real estate funds can be residential, they could be commercial, they could be industrial. Just depends on the type of fund. We also have real estate crowdfunding platforms. Now, these allow individual investors to participate in a real estate project with a relatively small amount of capital needed. Investors can choose specific projects to invest in, whether it's residential or commercial. And then third, we have real estate limited partnerships, LPs. These include general partners who manage the fund and then limited partners who invest capital. The limited partners invest money into partnership and they have limited liability, while the general partners are responsible for the fund's operations. There are additional subtypes of private placement like the 506C and the 506B, and we're going to break those down a little bit in case you hear about them as you start your investment journey. The 506C offering allows fund managers to advertise their fund to the public, but it's restricted to accredited investors only. Now, unlike the 506C, the 506B cannot be openly advertised to the public. So if you're watching social media or you hear people talking about their fund, it is more than likely not the 506B because the SEC frowns upon that and it's not allowed. So what are some of the pros and cons of these? Well, I think it's important to highlight the cons because most people who have a fund will sell you on the pros. I will cover both, but as always, be cautious. Number one, diversification. Private real estate funds often invest in a diversified portfolio of properties across different sectors, which can help diversify risk. Number two, it has hands-off management. Fund managers are typically experienced in real estate investing and are responsible for the property acquisition, the management, and that's all going to save you time and headaches. Number three is income generation. Many private real estate funds aim to generate regular income for their investors through the cash flow that comes in from the rental property, which will make it appealing for many income-oriented investors. Number four, potential for capital appreciation. Over time, the value of the properties in the fund portfolio may appreciate, which will lead to potential cap gains when the properties are sold. And next, we've got liability. Investors in the private real estate funds typically have limited liability, which means their personal assets are shielded from the fund's liabilities for any potential lawsuits. And last, access to investments. Private funds can have access to properties and deals that individual investors might miss independently. Now, let's talk about the cons. Those are the pros. Let's talk about the cons. The fine print that most people won't share with you, and there are 6 big ones. Number one, lack of liquidity. Private real estate funds are illiquid, meaning that they can be really challenging for you to sell your investment and ever access any of your capital before the fund's predetermined exit terms. This lack of liquidity can tie up your money for several years. Number two, a very long horizon. These funds often have a very long-term horizon, typically ranging from 5 to maybe 10 years, maybe more. So investors, you must be willing to commit your capital for an extended period of time. Number three, limited transparency. Private funds may have some limited transparency compared to publicly traded investments like REITs. Investors may have less visibility into the fund's operations, the assets, the data, the P&Ls. So always remember that you're going to probably see less in a private fund than you will in anything that's publicly traded. Number four, high minimums. Many real estate funds require substantial investments, which might be out of reach for some investors. 5 is the fees. They can have really high fees, including management fees, performance fees, which will all eat into your overall return. So make sure you always review all of the fees before you invest. And then 6, last but not least, limited control. Investors have limited control over those decisions and the property management and what you're going to acquire, when you're going to exit. And these are all typically made by the fund manager. Less headaches will typically always equal less control. Now, why is this important to you? because there are a few great private funds out there. There are. I have one, but there are a lot of bad ones. It's crucial to ask questions in order to gain a full understanding of the investment opportunity, the manager's experience and expertise, as well as the potential risks and rewards. So I want to give you a few key questions. I don't know how many there are. I think there's like 10, 12, 15 of them that I put together. These are questions that if you're ever approached to invest in something, these are questions that you would want to ask the person that's trying to sell you on the fund. Let's go through these. Number one, what are the specific types of real estate properties or project does the fund target? Meaning, are they residential? Are they commercial? Is it development? You want to understand that. Number two is, what is the fund's overall objective? Are you looking for income generation? Is it capital appreciation or both? Number three, how does the fund aim to achieve those objectives? Like, you want to know what their plan is in order to achieve that. Number four, what is the fund's manager's experience like? What's their track record? Like, anyone can get lucky once or twice in real estate. How long have they been investing? What type of projects have they invested in the past? What were those returns like? What did the investors get back during that fund? You always want to make sure that you look at the track record, the expertise, and the experience of the person that's running the fund. Number five, can they provide you examples of past real estate investments or projects that they've managed, and what were those outcomes? Six, how long has the manager been actively investing in real estate? Super critical. Seven, what is the fund's expected investment horizon, and what is the lockup period? Eight, are there any redemption provisions, and if so, what are they? 9, what fees are associated with the fund, including those management and those performance fees? Are there any other expenses? 10, what risk management strategies are in place to mitigate any potential downsides? 11, what processes are in place to evaluate the potential investments? Like, what do they actually go through in order to evaluate, is this a good property to invest in for the fund? 12, what is the fund's exit strategy for the investment? And how does it plan to provide liquidity to investors? 13, is there exit points or an estimated fund term? This is really important. 14, what are the returns on those past investments? Can they give you the IRR, which is internal rate of return, the COC, the cash on cash return, the total return, or even cash flow distribution based on other prior investments? Next, we have, how often does the fund provide those reports or updates, and what type of transparency and visibility do you get on the numbers? Another great question is, what level of transparency can you expect regarding the performance or any underlying assets? And lastly, are there any exit fees or penalties or early redemption charges? Or what happens if you need to exit the investment before the fund's intended exit points? Always remember that asking these questions is just the first step. And although how they handle their responses will tell you a lot, still make sure to do your due diligence, evaluate how this fits into your overall investment strategy, review all the fund's offering documents, and consider seeking independent advice before making that final decision. Investing in anything is a significant financial commitment, so make sure you do your research and make that informed choice. All right, guys. That is all for today's episode. We have an incredible series lined up for you with interviews and guests. I can't wait to share these with you next month. So hit that subscribe button. And if you love what we're doing on the show, please head over, leave a review on Apple Podcasts. It would mean the world to me for you to take a minute and support all the work that we are putting into the show. Thanks again for tuning in today. We'll see you next time.